Welcome to Retire Smart with David Brooks. I'm Chip Maxwell. Well, David, happy days are here again. The week ended up last week. We had the debt ceiling deal finalized, big market rally, a good jobs number for the month of May, and everything's fine. There's no recession looming.
Sure, Chip. Yeah, absolutely. Yeah. I would tell you that the market did rally after the debt ceiling over a week ago. That Friday, the Dow Jones rose 700 points. That's a pretty decent day. Um, the reality is, though, is can it last? Are happy days really here again? And I would tell you, and we talk about all the time. Sometimes we look at what we call technical indicators, the market's health from a technical standpoint. There's all kinds of different metrics to look at, and yeah, it looks great from a technical
Technical
standpoint.
versus fundamental.
But fundamental, it continues to deteriorate. So number one, we had ISM manufacturing numbers. So this is basically a gauge of how many new orders and activity are going on in the manufacturing section, contract for the seventh consecutive month. And these numbers got so low, we haven't seen these contraction numbers since 2008. So if businesses, Chip, are ordering less components and less parts into the manufacturing inputs of products or goods and services they sell, does that forecast higher sales in the future or lower sales in the future? What do you think?
No, that's going to be bad news.
Absolutely. And so these kind of contraction numbers can't hide. Now, the market as of this recording, Chip, was up a little over 10%. The S&P 500 was up a little over 10% year to date. And so people are like, "Oh, wow, man, the market's doing great." Well, is it? Well, I would have you know that 7 companies are responsible for basically 145% plus of that gain. So if we took the S&P 500 and cut it into the S&P 7 and the S&P 493, it's a very different world. 7 companies are controlling the market's growth year to date, and this is the big tech companies that have been on fire. So this is Amazon, Apple, Google, Facebook, Nvidia, we talked about recently, Tesla, right? And so these companies are driving all this growth, and their stocks have moved up. In fact, as of this recording this morning, the top 7 companies that are both the top 7 of the S&P and the Nasdaq, what's called top 100, or there's a ticker called QQQ. You can track those with. Those top 7 companies have grown in market cap. Get this, Chip, $3.4 trillion in the first 5 months of this year.
Well, that's mind-boggling, but you're saying on Main Street and out there in the small business world, the news is not the same.
No, that's more than the GDP of the United Kingdom. To put some perspective here,
Okay.
okay? So the bottom 409 or the other 93 companies in the Nasdaq 100 have only grown their market cap over $600 billion year to date. So you got 93 companies divided by 600 billion versus 7, 3.4 trillion. Can that kind of parabolic rise last? Historically, I don't know. Okay, I don't know. But historically speaking, the answer is no. And Nvidia, which is the chip company that just went crazy here recently, it's trading at over 200 times its earnings. And is that sustainable? So are you willing to pay 200 times what this company makes in a year to be a shareholder of that company? And for some people, the answer would be yes, if they're short-term traders, possibly. But if you're truly a long-term investor, I don't think Warren Buffett is taking a position in that stock. I mean, like, I don't know, but I would just tell you, they like to buy things that they think are undervalued, not necessarily overvalued. And so at some point, these things correct. They always revert to the mean, right? Mathematics is amazing how it's the universal language. And so I am fearful that the market will correct severely. Now, the other thing you mentioned, happy days are here. The debt ceiling deal was finished. And yes, the Senate quickly passed basically the House's version as it was and got it to Biden's desk, who signed it. But I will tell you, there are people out there, and we talked about it, Rand Paul and others, that say this was a horrible deal. And I have to concur. Not only that, most people are not understanding how much liquidity is going to be taken out of our economy because of this deal. The Treasury has to fill up its coffers again, and that means they're going to be pulling cash out of the system.
Sometimes, David, when these market rallies happen, you've used the word sugar high. This market rally, the one just over a week ago, as you said, right on the heels of the debt ceiling deal, was it another sugar high, or was it nutritious?
No, yeah, this is definitely there's no breath. In other words, if the market's breath widens out, I'd be a lot more positive on what the market can do if it can hang in here. But to have 7 companies kind of running the show or leading all that way, and 493 of the 500 largest companies are basically flat for the year, I think the S&P 493 as of today was up like 1.1%. So it's not really gone anywhere, right? For most companies. Now, there are some of the research places we get research from. One of my favorite economists, I mention him all the time, is Brian Westbury from First Trust Portfolios. They're based out of Wheaton, Illinois, Chicago area. They put out some just really good research, and he put out a piece over the past last weekend that I read, and I'm paraphrasing here. I don't have it in front of me, Chip, but basically he just talked about they think that it's a good opportunity to maybe take a little risk off the table if you own those 7 companies and maybe go buy things that are a little bit more in the value range that you'd be happy with. There's going to be growth happening in other areas. If the economy is really going to be healthy, then it would be prudent to go put that capital where you thought the growth was going to happen, not where it's already necessarily happened. And again, we're not making any recommendations. We don't talk about stocks or products, et cetera, on our show. That's not what we do. But my big takeaway here, Chip, is people need to make sure they're doing a risk analysis of their current holdings to find out if they're going to be susceptible. If things were to reverse for those 7 companies, or even 1 or 2 of them, that would change the indices quickly. And you may want to have somebody, a professional, give you some kind of understanding of your current risk tolerance. We have a tool we use here.
Well, that's the R in the SMART plan is for risk analysis.
I'd be happy to do that for folks if they would like. Complimentary, just run the risk analysis. We just need your statements to do that, really. But you could find out where you stand. But, I would just tell you, I would be very cautious going in, to the next quarter.
The market liked the debt ceiling deal. You do not. Why?
Because it doesn't stop us from spending, which is inflationary in itself. And here's the other thing. We're about to have the Federal Reserve meet again here in June, and the whole world thinks they're going to pause. I will tell you, the futures market thinks there's about a 40% chance they'll raise rates, which would surprise markets here. And with this debt ceiling deal, that's putting more inflationary pressure. And if the Federal Reserve decides to pause, we've even had their most dovish guy out there, Neil Kashkari, who's out of the Minnesota version of the Fed, say that, if we pause, it doesn't mean we're done. It just means we're pausing. Well, if they pause, they lose the efficacy of what they've done thus far. So I would argue if they think they're really behind the 8 ball still in inflation, they're going to go further than most people are anticipating. And they're certainly not going to cut this year, which is what most of Wall Street's talking heads keep telling you is going to happen. We just don't see it within the data, Chip. It's just probably not going to happen. So we are always looking at unique pieces of data, if you will, to find out how inflation is really working. And, Costco, I joke about it, has been one of these inflation busters, if you will.
Yeah.
You can still go to Costco and get a rotisserie chicken for $4.99. It hasn't changed.
Well,
you can still get the hot dog for $1.50, right?
But you sent me my kids love that, by the way. But you sent me an item from the transcript, and it's a statement from the CFO at Costco. And he says consumers shifting to pork is, in a sense, a recession warning. Am I looking at that correctly?
Absolutely. And so from their earnings call, they basically, the transcript I sent you, they are basically seeing people downshift, if you will, right? And we see this, and I joke about their, it's a great company, well-run company, but they are such a big retailer, Chip. The data you can extrapolate from big retailers can give you some kind of forecast. And what they're seeing is people are stopping buying steak, and they're downshifting. When they shift down, down to pork or chicken, or people that bought whole chicken breasts go down to chicken tenderloins, right? There's ways you can pinch your budget when you have to. And again, this is to help people understand. We're in the 27th month now, Chip, of over 5% inflation. So we've just started our 3rd calendar year with this kind of inflation. So you have to understand that's stacking inflation. So forget the 9% we had a year ago in June. Just use the 5% number, 27. So you had 5% 3 Junes ago, then you 5% last June, then 5% this June. So that's 15+% in inflation in your goods and services you're buying, your groceries, and groceries in general up over 21% over the last 3 years. How long can the American consumer sustain and continue to buy? And I would argue that I think they can't continue. And so, this is, I don't want to say it's definitive proof, but here's a leading indicator, a major retailer that sells a lot of groceries telling you people are downshifting.
A lot of economists and the market were cheered by, well, here's a CNBC headline. Payrolls rose 339,000 in May, much better than expected in resilient labor market. Do you see it that way?
I don't, because the IRS's revenue from payroll taxes has not grown much at all. And so if we have all these jobs coming online, we keep getting all these updated jobs reports, and they're revising other jobs back up. Why are we not seeing an increase in payroll taxes, income taxes collected by our federal government. And the reason is because there are a lot of hourly workers here, and these are a lot of part-time jobs, et cetera. And again, we've talked about this. Some economists have called out the BLS, the Bureau of Labor Statistics, on some of these employment numbers. Are they real or not? So who knows? I mean, yes, the last couple job prints have been really good, Chip. They really have. I mean, and you can take it with a grain of salt. But the proof will be in the pudding. Does the consumer get enough income? Are they being paid decent wages enough to keep up with inflation? And the answer on the wage inflation is a definitive no.
All right, so some of the surface level technicals look good, but the underlying fundamentals are still shaky. That's why you ought to get a report card. 402-369-7777. No charge, no obligation. We look at your entire financial situation. Maybe you're in good shape. Maybe you need to make some changes. Now is the time to find out, especially with the economic environment in flux. 402-369-7777 for a complimentary report card. 402-369-7777. Up next, our guest this week brings a wealth of knowledge and experience to every client and case in our SMART process. In fact, she helped build the SMART process. Financial advisor Dayne Lawyer joins us next on Retire Smart with David Brooks. Welcome back to Retire Smart with David Brooks. I'm Chip Maxwell. She balances the challenges of being a wife and mother with the additional challenge of being a financial advisor at Retire Smart. David, please introduce our special guest.
Yeah, thank you, Chip. And back in the studio this week, we have one of our financial advisors. Unfortunately, at this time, our only female financial advisors. But we're so glad to have her on the team. Dayne Lawyer, thank you for taking time to stop by this week.
Yep, always good to be back.
And, again, just speaking on what I just said, that is one of our industry's biggest problems is it's been such a male-dominated industry for so long. There's a lot of efforts of some of the bigger firms are trying to make strides to encourage and recruit folks in. So I just want to start off, Dayne, with just a moment of how you got into this business and how you and I actually met.
Yeah, we, obviously met when you moved here, and that was a blessing, obviously, and we've continued to pursue our relationship, and now here we are. But yeah, I honestly, this was never in my career path, but I wound up in the industry after a few failed attempts of what I thought I wanted to do the rest of my life. But honestly, this opportunity kind of just landed in my lap, but I fell in love with it. So it was just the ever changing, day to day of everything is always different and helping people. I fell in love with it. And like I've said before on different radio segments, I've worked my way up the ladder and wanted to make sure that as a woman, I got to where I wanted to be in a male-dominated industry. So,
Yeah, well, and just for those of you listening, Dayne was actually my assistant, if you will, for when I first got here to Omaha, and kind of worked in the business. And I was actually just coaching her on some personal financial stuff. She'd ask me questions as clients we were helping clients, and she got to know our business thoroughly, and then started to really understand how the tax strategy. So she's actually been with me longer than anybody. So she's got really in-depth knowledge. And I guess it was maybe 2.5 years ago, you kind of were like, I think I would like to actually become an advisor.
Yeah.
And I was like, well, go get licensed.
Yeah.
And you did. You put your head down and studied and got that on the side. And then, we're able to exactly promote you up through the ranks. And now, not only one of the advisors, you're kind of one of what we call our lead advisors here. And so you're very tenured on the team, and clients love dealing with you. But we always have you on the show, and I hate to pigeonhole it, but we kind of, we talk about how we have the advisors, I don't want to say are experts, but we have them kind of go deep in certain areas of knowledge. And for you, the passion has been kind of just helping women in general. So sometimes that means single women. It doesn't always mean single women, by the way. It's just women who want to understand the financial world a little deeper, a little better. And so we've put on special events, and we'll have one of those coming up, I think in the fall is the next one we've got scheduled with you. So we'll talk about that on your next time around on the show. But just how women have to pay attention differently than men, simply because actuarial data. And I love the stat you brought it out last time. I think what's the 80% rule?
yeah, it's you're putting me on the spot. 80% of men will die married, and 80% of women will die single. So, and with that following that pattern, on average, women are going to live 8 years longer than their male counterpart. So that plays a big role statistically speaking. Typically, when I meet with clients, the male is always the more involved one. So speaking to women is again my passion, making sure that they get involved when they need to.
Well, absolutely. And my wife, Melissa, who you know really well,
Mhm.
and for years, my wife wants to know that there's a plan in place, and she always says, "Something happens to you. Who do I call?" You know,
Yeah.
and that's all she wants to know because she does not like this stuff. And there's different people that are different strokes, different folks, and it's not the case in every family, but our industry is always taught, and I joke about it. I mean, this is going back almost a quarter century. I started this business where these brokers at the old Stogie Wall Street firms would only talk to the male of the family, literally wouldn't even talk to the wife, and it was a transactional relationship. It's just hilarious, and they wonder why they struggle to connect. But anyway, so we're trying to do everything about that. So make sure you pay attention if you, or you can even call now, by the way, and get pre-registered when we have the dates in the fall. I believe it's September, and we're gonna have our next Inspiring Women event. And Dayne's done several of those for us, and the response is always phenomenal. But let's talk about, you brought an article along this week to kind of chat about here, and I apologize because my travel schedule, I have not thoroughly read the article, but basically it talks about there's 5 really common financial challenges women in general have to or really need to address or
Mhm.
overcome so that they're not going to be caught kind of like, uh-oh, what happened when somebody maybe who else was handling things and now they're thrown in the driver's seat, right?
Right, and they're unique to women as well. Obviously, there's a lot of factors that women have to navigate on their own. Majority of the time, though, a lot of these bullet points will discuss will more encompass single women. But there's 5 specific ones here that typically women find themselves trying to navigate, and then what to do to help mitigate or get you through that.
So let's talk about the first one, and that's the income gap. And just so you know, for any feminists out there, it's not necessarily just because you get paid less. The income gap is significant because you are the only ones that can bear children, and
Hmm.
therefore you're going to be forced to take time off from work at certain points. I mean, I was blessed. Melissa, my wife, was able to take over a year off each time our kids were, and we just made that decision. We did not have the resources we have today. This is years ago, but we just made that decision. And a lot of women want to make that decision, right?
Right.
Or and take extended leave, et cetera. So there's an income gap they face basically in their lifetimes.
Yeah, so that impact, there's a stat that was in this article that women earned on average 84% of what men earned in 2020. But like you had said, there's a lot of things that go into that as well. We're the only ones who can have children, and if you're lucky enough to have paid time off for maternity leave, that comes into play as well. And especially, as a woman in my position in industry, those are 2 to 3 months off that you're not, you know, in the conference room meeting with people. So it is a real contributor to that gap.
And of course, there is historical bias in the actual pay scale. As you mentioned, the 84%. And
Mhm.
there's various factors there. The good news is that seems to be getting better,
It is.
a
It
lot
is.
better, a lot faster for most industries. I know some of my leadership team, most of my leadership team is actually females, and they're
Mhm.
well compensated, et cetera. So the good news is there is changes coming, but from a historical standpoint, especially those women that are getting out there that are about or near retirement, they don't have time for that salary, which is being caught up by society to really catch up enough to make a difference for them as they're going to walk into retirement knowing they've earned 16% less over
Yeah.
their lifetime,
Yeah.
right?
So takeaway from that is obviously women out there, for the younger listeners who are with us right now, start saving early. Obviously contribute to your retirement plan, get that match. Obviously compounding interest is huge. So the longer you have on your
And
side,
when you're
it's
putting into that retirement plan at work, use the tax-free side, i.e., the
Mhm.
Roth version, which 88% of all plans have today, if you can, and you get to keep that money tax-free. So that's our
Correct.
second point, right? In your
Yeah.
article is
Yeah.
women unfortunately seem to delay starting their savings plans, right?
Yes. And this is a Transamerica survey released in 2020. Just 68% of working women are currently saving for retirement. That's, versus 82% of men who are currently saving. But again, a lot of reasons go into this. Again, that pay gap due to maternity leave. Most women feel obviously obligated to, if they have children, be the ones to stay home, take care of them, take them to the doctor. I'm really lucky. My husband steps up a lot, with our 2 children. So, unfortunately, though, when I had mentioned a lot of single women come into play in this article because they don't have that option. But, like you had said, getting started early in that compounding interest, this stat really stood out to me because the difference is huge. But a woman who contributes 10% if she's earning $75,000 salary for 20 years could retire at 65 with 586 100,000 in savings. But if she would have started just 5 years earlier, she would have had almost $300,000 more in retirement
So
savings just from those 5
586,000
years.
versus almost 900,000.
Yeah, 850. Yep.
Yeah, that's a big difference, folks. So now another problem in general, the study pointed out was on how aggressively or conservative people invest, and women in general. Again, this is what the study produces.
Yep.
Unfortunately, choose almost to be too conservative early on in their investing career.
Yeah, typically, obviously, there's a lot of things that come into play, your risk tolerance, your timeline, things like that. But obviously, the younger you are, you want to make sure you're a little bit more aggressive. But one of the things we do here in the office as well is figure out what your risk tolerance is. And obviously, we work with families that are retiring and things like that. So making sure your risk tolerance is where it needs to be, depending on what phase you are
Yeah,
in your life.
I think that's really important. Why it's good to work with a fiduciary based or an independent based financial planner in this area, because if you're investing too conservatively, whether it's early in your career, you're going to lose the power of the compounding of that growth, or you're even close to retirement. And we talk about all the time. Yeah, it's okay, and it may be appropriate to take a little risk off the table, but you need to understand how to get risk adjusted returns, which is working working with a professional like Dayne
Hmm.
can help you understand. So we don't run out of time. I want to move on to that last one, and that is that they are not saving for healthcare in retirement, and that kind of jumped out at me as like, wow, I would think that women would be more instinctive in that area than men, but this is a problem, right?
Right, it is. And it's one of the things we don't necessarily, a lot of women don't think about. If you have a HSA compatible plan, you want to make sure you're tucking money into that as well, just as another, vehicle for your savings, because that's triple tax free. You can use that money, tax free.
Okay,
For
you really big point right there. So I want to make sure we say, so an HSA, what Dana's talking about, that's a health savings account. It is the only triple tax-free account available in America today. Let me explain that. You put money in there, it goes in tax deferred. You get to take it off your income for making the contribution. It grows tax deferred, and if you take it out for a health related expense, as long as it's what we call a qualifying expense, it comes out 100% tax free. This is huge. Now, you have to have an HSA compatible health plan at your workplace or on your own if you're going to use this. But if you do, a lot of employers offer this, and people leave it off the table because they think, oh, that's this higher deductible plan. I don't want that. And that alone could be a huge planning mistake, right?
Yeah, it can. We want to make sure that obviously you're tucking money away into the appropriate places and utilizing that. And, as a last tidbit on there, planning for long term care expenses as well. Again, bringing in the, difference in life expectancy. Women often face that as well.
Well, all right. I want to jump to our last point because this is something that's probably, unfortunately, for a lot of listeners right now, a very real thing. Women will tend to carry higher credit card balances than men. Now, I'm not saying you're shopaholics or what have you, but the data right now from the credit card industry is a little scary. We recently had, a month before last, a 17% jump in balances nationwide, and we have $1.3 trillion as of today on credit cards in America. And if there's a recession coming, interest rates are rising. This could be it could be catastrophic.
It's catastrophic.
Right?
Exactly. That was the word I was going to use. And on average, again, women have lower credit scores than men. If, geographically speaking on the same line, lower credit scores. And obviously, like you had mentioned, interest rates. So it essentially eats you alive if you're in debt. It's so hard to get out of that. But again, with the income we discussed and things like that, sometimes women just find themselves in a position where they essentially don't have another option. So,
So a lot of things to ponder. That's a good article you brought. So there's a lot of nuggets in there. I know we're running out of time here today. So here's what I'm going to do is we're going to offer any of you ladies that are listening in particular that would just like to schedule a 15-minute phone call with Dayne. We will do that for you, but you're going to have to call. We're going to limit to just the first 5 because Dayne has got a very busy schedule. So the first 5 people that call, we will schedule an appointment over the next 2 weeks with Dayne. Our team will work to get her calendar figured out where she can just answer your most pressing questions. There's no obligation. This is just any age, wherever you are in retirement, whether you're married, you're single, you're widowed, divorced. You just want to have somebody kind of talk you through what you should be looking at, even if you're not the one that runs the the money or the finances in your household, Dayne can help you out there. So if you'd like to take advantage of that and have a 15-minute phone call with Dayne, again, we can only take 5. 402-369-7777. Dayne, thank you so much for stopping in the studio this week. We really appreciate it.
Yeah, thank you.
And also, you can get registered for her upcoming Inspiring Women, which will be sometime in the fall. We are out of time for this segment. Thanks so much, Dayne. Chip, what do we have next?
Up next, you have questions. David Brooks has answers. Q&A is next on Retire Smart with David Brooks. Welcome back to Retire Smart with David Brooks. I'm Chip Maxwell. Into the Q&A we go. David, the first question is about annuities. I read and hear conflicting information on annuities. Some financial advisors love them. Others won't touch them. Can you summarize the options and tell us whether you like annuities?
So annuity refers to a product, okay? And we rarely ever want to talk about product on this show. That's not what we do. And we don't focus our process is focused on the client. We have a proprietary process we put our clients through. So we're not product salespeople. A lot of financial professionals, what they do is they sell a shiny object, Chip, right? And so to the questioner's point, the word annuity, you have to understand what it means. It's a contract, right? And the word annuity is, if you derive from the old Latin version of it, it just means income, right? And so annuities, there's many types of annuities. There's gift annuities used for philanthropic reasons. For a lot of hospitals will have gift annuities set up where you can do some charitable giving with them. But there's 4 main types of annuities that are typically used when it comes to retirees. And they're not all good and they're not all bad, all right? But it would need to be appropriate from a suitability standpoint where somebody would recommend an annuity to someone. But the problem is, does it do what it says it does? And this is where I get have issue with some of the folks out there that will use these, and they talk about things like, oh, this has this big bonus on it, what have you. And many times that bonus is what's called a funny money value. It's just to a perceived future income value, not the actual cash value of the account. There's many factors. So first off, the first type of annuity is simply what's called a variable annuity. And it's not a simple contract. It's variable in nature. Your money's fully invested in the market. It can lose money. It can go up. It can go down. But the annuity portion of it is an insurance contract that is an umbrella over the policy, right? And so the investments can grow tax deferred if it's not in a tax deferred account already, like an IRA or a Roth IRA. So you could put money in there and not have to pay tax on that gain until you touch it. But a non-qualified annuity, when you do touch it in the future, you need to be forewarned, is taxed as income, not capital gains. So if someone were recommending someone buy this variable annuities, let's just say put $200,000 in here, we think the market's going to double in the next 10 years, and they tell you, oh, it'll be $400,000, but if it doesn't, there's an insurance component. So if, gosh forbid, Chip, you owned this and you were to pass away maybe in year 5, and the value was maybe $170,000, the insurance component would make sure that your beneficiaries were given at least what you invested back in there, $200,000. So there's an insurance component, but it comes at a cost. There are fees, right? So if it's invested in the market, it's going to have what's called sub-accounts or mutual funds, and they're going to have an average expense ratio of about 1% a year. Then there's this rider usually they put on there, which is guaranteeing either a death benefit or an income in the future, and that usually has a fee of north of 1%. And then there's what's called mortality expense or M&E fees on these, and I think according to Morningstar, the national average is around 135. So these contracts can have literally 2.5 to 4.5% in annualized fees. And if you thought the market was going to do 7% in that example we gave earlier over 10 years, your cash value is really going to go probably at about half that. And historically, that's what we've seen. Now, I used to use these products. I do not offer variable annuities to any of my clients because we simply don't think that the internal rate of return usually works out. But if you were unfortunately terminal, could there be a case where this could be used? Absolutely. If someone had a terminal disease and knew they would not be around in 10 years, Chip, they can invest in the market and get an insurance component. There's no underwriting. So they get that insurance component, if you will, for potentially, without having to go through any type of underwriting. So therefore, they could expose their assets to growth in the market, which could benefit their beneficiaries. But if it went down, they may not lose anything because of the insurance component. So could it be used? Absolutely. There's never a never use this or never not do that or always use this or always use that. But in general, variable annuities, in my humble opinion, are usually too expensive for most people. Now, second type of annuity, and I'm sorry, I'm just getting a little winded here, is simply a SPIA or a single premium immediate annuity, SPIA. And this is a pension. You retire from work, they're going to guarantee you a check every month. Well, a lot of companies don't want to have the risk of giving you that check, so they'll sell that risk off. So if Chip is retiring on this day, he's this age, and we owe him $700 a month, whatever that number is, they can go to the insurance world and have an insurance company say, give us a check for this amount, and we'll make that guarantee. That's an actuarial bet the insurance company's making on your mortality, right? And so they could sell off the risk and just write a lump sum check. And by the way, folks, that's why most pensions offer you a lump sum. It's the same thing. Instead of selling the risk off, they'll give it to you, right? And so that's what's, and you can also buy these when interest rates are up like they are. You can buy them for to just give you income over a period of time. So you could give the insurance company $100,000. Maybe you're 62 and we don't want you to turn Social Security on. Maybe we buy you an income check immediate. So you give them $100,000 and it's a single premium, immediate annuity. Immediately it starts paying you income right back, right? For maybe 7 years. And you could buy for what's called period certain. So we could buy for 5 years, 7 years, 10 years. And when interest rates are really high, like they were years and years ago, these were very useful tools to maybe get a client to delay taking Social Security or something else within their overall financial plan. But again, with interest rates being as low as they've been in the last 10 years, they've not been very popular vehicles. That brings us to the third type of annuity. That's called a fixed annuity. It's not exactly a CD, Chip, but think of it almost as a CD from an insurance company. It does not have FDIC insurance, of course, but it's basically backed by the full faith and credit of the insurance company. The insurance company will guarantee you a fixed rate of interest for a fixed period of time. And so this might be 5% for 5 years right now in today's marketplace. I don't know the exact rates. I'm just giving you hypotheticals here. But basically, if you were, the advantage over the CD is if you're worried about banks, insurance companies typically have much higher insurance reserves, cash reserves, than banks do. Banks usually have to keep about 10% in the vault, so to speak, of all the dollars that they allegedly have on their balance sheet. Insurance companies, if they're A-rated, it's going to be over 100%, dollar for dollar. And because they have to pay out every death benefit within 96 hours or so. So they may guarantee you 5%. And the advantage of the CD is that the CD, you have to stop and pay interest on your tax return every year along the way. With the insurance company, you would only pay the tax on that interest in the final year. So you may be able to defer that interest for 5 years. And with the lower tax rates we have right now, that might be a good thing while you're doing other strategies like Roth conversion. So that could make sense. And then that leads us to the fourth type of an annuity there, Chip, which would be an indexed fixed annuity. That's instead of taking the guaranteed interest rate, you're willing to risk the interest. And basically, they're going to take that interest to kind of keep this really simple an example and buy options on the upside of the market. And so you get a portion of the upside of the market, typically around half or something like that. So if the S&P went forward 20%, you might get 10% earned on your contract with zero risk. Now, the downside is the market were negative during that crediting period, and that could be 1 year or multiple years. You would get a zero, right? But
that's better than the damage that would hit you if you had a variable rate and could actually go negative.
Absolutely.
Yeah, so you might not get all the upside, but you don't risk the downside.
Do I personally own annuities? Yes. My wife likes them, right? She likes no risk. I like risk, right? And so it can be an appropriate vehicle for the right person. But the biggest thing is you need to have somebody put together a true holistic financial plan, and the risk tolerance needs to be thought in there. So it can be appropriate. You need to understand the time frame, the cost of expenses, if there are any, and there are actually ones out there that have zero expense or fee to the client. The time is the cost. You have to be willing to commit the dollars for a certain period of time for those, right? And if it's appropriate in your overall financial plan, and does it work with your tax plan, your income plan, et cetera. I know that was a long-winded answer, but
well, it underscores why we offer the complimentary report card, because you have to look at all the variables and make sure it fits, make sure that it makes sense. All right, how about differing expectations? I always get a kick out of this, David, when this comes up. The question is, my husband and I are in our mid-60s. We're about 4 years from retirement. We have saved about $1 million in several retirement accounts. We think we're in good shape financially, but we have not thought much or talked about life after we retire. We've been focused on working and raising 6 children and already have a few grandchildren. I know you do tax planning, but what about day-to-day and year-to-year reality in retirement? Is that part of your SMART process? It is, David.
It absolutely is, and it's a great question. So in other words, one of the things we'll ask you typically in your first visit into our firm, this is before you engage our firm, or before we have to find out, and we want you to go home and think about it usually. So we actually don't want you to engage our firm when you first come visit with us. We want to learn about you, right? What are you trying to, but one of the exercises we'll do typically is we'll ask you about what we call a perfect day, right? What is a perfect day in retirement for you day to day? What does that look like? And does your financial plan actually line up with that? Now, when it comes to married couples who sometimes will have differing opinions, one of the exercises I used to do quite frequently, and I've taught some of the advisors on our team to do this, is when clients are having a little, let's just say, disagreement on what that looks like, the day-to-day part of retirement, I'll just give them a yellow pad each, a legal pad, and, hey, Chip, I want you to write down the top 5 things you want to accomplish in your retirement, bucket list items, things you've wanted to do, whether it's restore a car, travel the world, et cetera. And I'll ask your wife, Pam, hey, I want you to do the same thing. Don't look at each other's notes. List the 5 down. What we uncover is the top 1, 2, or 3 are almost the same things. They might be in slightly different order, but numbers 4 and 5 often, Chip, they've never even told their spouse this is one of their bucket lists.
My wife and I went through that exercise. It was revealing. Yeah.
Well, and I remember having a conversation, you guys, about the house you will eventually retire to
Yeah.
on this very topic. Right?
Yeah.
Wait, what, we're moving to the country? What? And for like my wife, it was the Harley. I was pretty clear. She asked me to sell the motorcycles. I used to have a bunch of motorcycles and toys before we had kids. When we had kids, I agreed to get rid of the dangerous motorcycle, right?
Okay.
But I also agreed, remember, having the conversation concisely and clearly, that once our children were adults, I'd be able to go get one again. And then, when my youngest became an adult, that weekend I went out and got my
Vroom,
Harley.
vroom.
Yeah, and she's like, "What is this?" I was like, "We agreed on this 18 years ago. What are you talking about?" So, but make sure you have those things aligned. It will make the planning process a lot easier. And we will question you. And a good financial advisor, whoever you go see, should have some kind of process to uncover these things to make sure you're applying aligns for whatever these items might cost, whether it's world travel. And we have couples, let's face it, some will go travel the world, the other one stays home. They won't even go with their spouse. And I get it. My wife doesn't like to travel. I drag her on a couple trips with me. I love traveling, right? So we got to have a plan that accommodates everybody in the plan. I know these were long-winded answers this morning on our Q&A section, but this is why it's so important, Chip. You have somebody who has a planning process. Our proprietary planning process here is called a SMART plan, and we have a report card that we can offer up front, where we can show you holistically a 30,000-foot view of where you are and how you score in these different areas that are going to matter. And then if you find out what it's like to work with a firm like ours, and there's no obligation to do it.
So we're out of time for Q&A this week, but get all of your questions answered by going through the report card process. 402-369-7777. No charge, no obligation. 402-369-7777 for a complimentary report card. Up next, have you heard about Mr. Bean and the electric car? It's not a new movie. It's real. We'll tell you about it next on Retire Smart with David Brooks. Welcome back to Retire Smart with David Brooks. I'm Chip Maxwell. Well, David, Mr. Bean, Rowan Atkinson, the British comedic actor, was the subject of a story. This is from The Guardian, the British newspaper The Guardian, and the headline is, "I love electric vehicles and was an early adopter, but increasingly I feel duped." I did not know Atkinson. Apparently, he studied electronics in school. And he's got a passion for motor cars, as he put it, but he's becoming disenchanted with electric vehicles.
I can't imagine why. Now, I don't want to go too far in the climate change discussion here, but the idea, all these cars are better for the environment. And as he points out, actually in the article with good data, he's absolutely correct. Once you have the car, right? Once you've got the car, the emissions are very low. But the emissions to create the car, I believe it was 73% higher. And again, if you're a climate activist, you might want to look at some new research that just came out. There's over 5,300 acres of new ice on Antarctica in the last 10 years alone. This is NOAA data, so this is from NASA and NOAA. But so, if climate change were really the big problem that it has, and by the way, there's another study that CO2 gas from 1750 till this year, so the 300 years plus here, 500 years almost of data there, only 12% of the rise in temperature, which is of course fractional, was due to human involvement in any way, shape, or form. But anyway, what he's talking about is that people used to jump on this. It was Green New Deal, et cetera, and there's tax incentives in these different countries. And by the way, right here in the Omaha World Herald, we just had an article this weekend that talked about the tax incentives up to $7,500 if you want to buy an EV car, but only 15 of the 49 manufacturers that currently sell these vehicles in the U.S. qualify for that tax credit, right? But what he's really focused on is the true net benefit or lack thereof of greenhouse emissions in the manufacturing of this, because they burn through 73% more CO2 to create this car, mainly because of the battery. These batteries are lithium batteries. And if you've never done it, just Google a picture of a lithium mine. If you're worried about being friendly to the earth, they are not friendly pictures to the earth's cycle. And it's very, very expensive. And the technology doesn't last long enough for the benefit to equate out, which is what he points out in the article.
Well, I remember the look on your face a few weeks ago when I asked you if you had an electric vehicle, and so Rowan Atkinson shares your concern. Apparently, Mr. Bean, you're in good company, David. Um, hey, let's shift gears here. You sent me a chart. This is from Redfin, a national real estate brokerage firm, and it's year-over-year growth in investor purchases. David, what am I looking at, and what does it mean?
Well, we just now hit the largest decrease on record of investors buying real estate, right? So we know during COVID there was a lot of cash buying going on, house prices went up, et cetera, and investors were buying this. And as we talked about, I think last week or the week before, Chip, not so savvy investors were getting involved in this and buying homes, and a lot of people were buying houses for Airbnb and other things and thinking, oh, I'm going to make a fortune. Well, when the economy turns, it may not work out. So we had a 49% drop, according to this chart, year over year of investor purchases on single family homes. So the market is drying up at the most aggressive rate ever. And if you all you have to do is look at the graph, Chip, take a look on that graph and go look when the last time it went negative for more than 3 or 4 quarters. That was 2006 through 2009, right? So we had a brief dip during COVID, like 2 quarters or so, or 3 quarters. But if you look on the graph, you go all the way back 2006 through 2009. We went through the housing crisis, and these numbers are now below the trough there on those numbers on the graph, and that's pretty scary. If the investors are walking away, then that means prices are certainly going to do what? They're probably going to have to fall.
Oh, the
right?
bottom's going to fall out because, as you say, now I see it. Okay, this is even worse than in 07, 08, 09,
And with
in
interest
that
rates
range.
currently, 30-year
Wow.
mortgage is currently over 7.1% as of this recording, right? The people that have to finance these purchases, the retail, or just the regular home buyer, can't really afford the home. So we're going to see some price corrections and changes here. What's working is home buyers are still be able to sell their inventory because there's still limited inventory out there, but that will run its course as well. And again, if housing is not doing well and banking is not doing well, we've talked about it in recent shows, those are very ugly forecasts for the coming economy, unfortunately.
Well, and you're a data-driven guy, and this is solid data. I guess the term of art right now is granular. It's right down. Redfin looks at county records across the nation when it builds this data and puts this chart together. So there's no doubt in your mind that we're in serious.
Yeah, and as I've mentioned here, just in my own neighborhood, I've seen houses that take, we're selling in 3 to 10 days are now taking 3 months to sell just where I live. And by the way, if you live here in Douglas County, here in Omaha, you just got a little piece of mail you probably didn't want to open up, and that was your new assessment.
There's a
on-
shockwave
yeah.
going across the state.
So
Yeah.
I will tell you, remember, those assessments were put in place by the previous assessor, not Walt Pfeiffer, who's our current
Walt
county
Pfeffer,
assessor.
yeah.
Pfeffer,
Yeah.
excuse me. But he has been out on social media of various sorts telling you how to go through the process to reduce your valuation. And there's going to be this is the kind of data you can use to win those arguments, by the way. So don't let someone raise the price of the value of your house precipitously, which is going to increase your taxes to going to all these school boards, et cetera, that say they never raise your taxes. We just had one of our employees, their house in Lincoln just went up $59,000, and this house is not a $300,000 house. That's a big move in valuation. And so please make sure you understand the process on how to fight your valuation if that's something that is important to you.
Well, and to that end, since we're talking taxes and challenging taxes, at least as David often says, the Supreme Court has said you don't have to leave anything on the table. It's perfectly fine for the citizen to safeguard every hard-earned dollar that he can. So the tax planning guide is designed to help you do that. It's 32 pages. You hear David offer it throughout the show. That tax planning guide is out there for you. But if you really want to take the plunge, get the report card. That is the comprehensive review of your entire financial situation, including your tax situation. As we say, maybe you're in good shape. It's good to know that. Maybe you need to make some changes. And if that's the case, boy, now is the time. Don't hesitate. At least get it checked out. 402 369 7777. There's no charge and no obligation. 402 369 7777 for a complimentary report card. David, bring us home.
Hey, we got family in town, so we'll be out and about visiting a lot of sites this weekend. Hope you guys are having a blessed week and enjoying the weather.
Thank you for listening to Retire Smart with David Brooks. I'm Chip Maxwell. For David Brooks and the entire team at Retire Smart, have a great week. Annuity guarantees and protections are backed by the financial strength and claims-paying ability of the issuing insurer. Annuities are not a deposit of, nor are they insured by, any bank, the FDIC, the NCUA, or by any federal government agency.